January 21, 2008. Société Générale executive walk into their Paris headquarters on a Monday morning and discover a 73 billion problem. One trader, 73 billion euros in unauthorized positions. That's bigger than the bank's entire market value. His name was Jérôme Kerviel, and he'd just created the largest rogue trading loss in history. $7.2 billion vaporized in 3 days. When they unwound his positions, European markets crashed 6%. This wasn't just a bank problem. This was your problem. If you had a retirement account, a pension fund, any investment in 2008, you felt this. And the terrifying part? He almost got away with it. For 3 years, he'd been hiding positions so large they could move entire markets. How does one junior trader hide 73 billion euros? The answer reveals everything broken about the banking system. And it's about to happen again. If understanding how the financial system actually works matters to you, hit that like button and subscribe. Jérôme Kerviel wasn't supposed to be interesting. Born in 1977 in Brittany, France, middle-class family. His father was a blacksmith, his mother a hairdresser. He studied finance at University of Nantes, nothing remarkable. In 2023, he joined Société Générale. But here's the critical part. He didn't start as a trader. He started in the back office. The back office handles settlements, compliance, trade confirmations, the unglamorous work that makes sure trades actually happen and rules get followed. For 5 years, Kerviel learned every control system, every verification process, every check that was supposed to prevent fraud. He understood exactly how the bank monitored traders, which means he understood exactly how to avoid that monitoring. In 2005, Société Générale promoted him to junior trader on the Delta One desk. Delta One trading is supposed to be boring. You trade index futures. European stock indices like the DAX, the FTSE, the Euro Stoxx 50. It's arbitrage, tiny price differences between the future and the underlying index. You're not supposed to take big directional bets. You're not supposed to have opinions about whether markets go up or down. You just execute client orders and capture small, safe spreads. Kerviel's official trading limit was $125 million. That's what the bank authorized him to risk. For context, that's already a substantial position for a junior trader. But almost immediately, he started exceeding it. Small, unauthorized trades in 2005, then bigger ones in 2006. By 2007, he was regularly running positions in the billions. And here's what made him different from every other rogue trader in history. He wasn't losing money. He was making massive profits. Nick Leeson brought down Barings Bank in 1995 by hiding losses. He was gambling to recover from mistakes. John Rusnak at Allied Irish Bank lost $691 million the same way. Hiding losses, doubling down, hoping to recover, that's the typical pattern. But Kerviel was different. In 2007, his unauthorized trades made approximately $1.4 billion in profit for Société Générale. The bank collected that money. His supervisors saw the profits on the books, and they never asked how a junior trader on a boring arbitrage desk was generating returns that good. This is crucial to understanding what happened next. Kerviel wasn't motivated by money. He lived in a small apartment. He didn't buy cars or watches or take expensive vacations. In 2007, when he'd made the bank over €1 billion, he was offered a bonus. He turned it down. He refused the money. What he wanted was recognition. He wanted to be seen as a talented trader. He wanted respect from the institution, and the institution gave him something else instead. They gave him trust. When compliance systems flagged his trades, supervisors dismissed the alerts. When position reports showed anomalies, managers accepted his explanations. He was profitable. He seemed to know what he was doing. And in banking, profit buys a lot of forgiveness. But profit built on hidden risk isn't profit. It's a bomb with a timer. And in January 2008, that timer hit 0. Here's how you hide $50 billion on a trading desk. You create fictitious trades that appear to offset your real positions. Kerviel would take a massive long position in European futures. Then he'd enter a fake short position of equal size into the bank's systems. On paper, his net risk looked like 0. The bank's risk monitors saw balanced positions, no alarms, no problem. The fictitious trades were forward-dated futures, contracts set to settle months in the future. Before settlement date arrived, he'd cancel them and enter new ones. The fake trades never actually executed. They existed only in Société Générale's internal systems. And because he'd spent 5 years in the back office, he knew exactly which codes to use to make them look legitimate. He used real counterparty identification codes from actual brokers. He knew which combinations would bypass automated checks. When trades are entered with proper counterparty codes, formatted correctly with realistic prices, the system accepts them. Nobody manually verifies every single trade at a bank processing hundreds of thousands of transactions daily. The controls are automated, and Kerviel had designed some of those automated controls. But the system wasn't completely blind. Between 2005 and 2008, Société Générale's risk monitoring systems triggered 75 separate alarms on Kerviel's positions. 75 times, the automated system said something is wrong here, and 75 times his supervisors dismissed those alarms. When questioned, Kerviel had explanations ready. The trades were client-driven. They were part of an approved hedging strategy. There was a verbal authorization from a senior trader. He'd send emails with plausible technical justifications, and because he was generating enormous profits, supervisors wanted to believe him. This reveals 5 catastrophic control failures at Société Générale. First, segregation of duties. A trader with back-office knowledge should never be allowed to trade precisely because they know how to game the controls. Second, limit monitoring. Kerviel exceeded his $125 million limit by a factor of 400, and nobody stopped him. Third, position verification. The bank never confirmed his fictitious hedge trades with the counterparties he claimed to be trading with. Fourth, trade confirmation. Forward-dated trades that kept getting canceled and rolled over should have triggered manual review. Fifth, management oversight. When a junior trader generates €1 billion in profit doing boring index arbitrage, that's not genius, that's a red flag. But here's the psychology that made it work. Kerviel's supervisors were paid less than the traders they supervised. A successful trader at Société Générale could make millions in bonuses. Compliance officers made fixed salaries. This creates a power dynamic where risk managers are afraid to challenge profitable traders. Add in institutional pressure for growth. Société Générale was aggressively expanding its trading operations in the 2000s, and you get a culture where questions are discouraged. By December 2007, Kerviel held approximately $50 billion in long positions across European equity futures. To put that in perspective, Société Générale's entire market capitalization was $36 billion. One trader controlled positions larger than the bank's total value. His fake hedges showed zero risk on the books, but in reality, he had more exposure to European markets than some sovereign wealth funds, and those markets were about to collapse. December 2007. Kerviel is sitting on $50 billion in long positions betting European markets will rise, and for months he's been right. Markets have been climbing. His positions are profitable. But something is changing. American subprime mortgages are defaulting. Credit markets are freezing. Bear Stearns has just bailed out 2 of its hedge funds. The first, cracks in the global financial system are appearing. January 2008. European markets start declining. Every point the market drops, Kerviel loses hundreds of millions. His positions are so large that small market movements create enormous swings in value. By mid-January, his unrealized profits are evaporating. But the fake hedges are still there in the system, still showing zero net risk. Nobody at Société Générale knows they're about to lose billions. Friday, January 18, 2008. A routine settlement check flags some of Kerviel's forward-dated trades. The operations team notices that counterparties aren't confirming these positions. Settlement mismatches aren't unusual, but these trades are enormous. They escalate to compliance. Compliance contacts Kerviel. He's vague in his responses. They escalate further. By Friday evening, senior management is asking questions. Kerviel isn't answering his phone. The weekend. Société Générale executives spend Saturday and Sunday reconstructing Kerviel's actual positions. They pull every trade he's entered. They contact counterparties. The fictitious hedges start unraveling. And underneath, They find the real positions. By Sunday evening, they know. He's holding $73 billion in European equity futures. Markets have been falling. The positions are underwater. And Monday, markets open. January 24, 2008, 9:00 Paris time. Société Générale's executives face an impossible decision. They can hold the positions and hope markets recover. But markets are falling on subprime fears. Every day they wait, they risk bigger losses, or they can sell everything immediately and take the loss now. But unwinding $73 billion in a falling market means selling into panic. Their selling will accelerate the decline. They'll move the market against themselves with every trade. They choose immediate liquidation. For 3 days, Société Générale traders dump European futures into the market. 73 billion euros of selling pressure. January 23rd, European markets open down and keep falling. The Euro Stoxx 50 drops 3% in the first hour. By close, it's down 6%. Financial News reports a mysterious wave of selling. Nobody knows it's one bank liquidating one trader's positions. January 22nd, the selling continues. Markets remain under pressure. Rumors spread about a major European bank in trouble. January 23rd, the final positions are closed. The final tally? $4.9 billion in losses, $7.2 billion. Société Générale has just lost 14% of its market value in 3 days because of one trader. But here's the truly disturbing part. Those 3 days in January correlate with one of the worst sell-offs in European market history. Kerviel's liquidation didn't just hurt Société Générale, it hurt everyone holding European stocks. Your retirement account, your pension fund, index funds around the world. One trader's unwinding moved entire markets. And Kerviel? He'd fled Paris that weekend. 3 days later, he walked into a police station and surrendered. But the damage was done. Now the question was whether Société Générale would survive. Société Générale wasn't some startup bank. Founded in 1864, it had survived 2 world wars, the Great Depression, multiple financial crises. It was one of France's largest banks, 1 trillion euros in assets, 30,000 employees. It financed French businesses, held deposits for millions of customers, was deeply woven into the European financial system. And on January 24, 2008, it announced that one trader had just costed $4.9 billion. The stock collapsed 4% in minutes, but here's what made this existential. That $4.9 billion loss represented 14% of Société Générale's market capitalization. In one announcement, the bank lost more than an entire year of profits. Credit rating agencies immediately reviewed the bank for downgrade. Counterparties started questioning whether Société Générale could meet its obligations. The classic death spiral was beginning. Lose money, lose confidence, lose access to funding, die. Société Générale needed capital immediately. By January 28th, 4 days after the announcement, they launched an emergency rights offering. $5.5 billion in new shares. They had to raise more money than they'd lost just to prove they could survive. French institutional investors were pressured to participate. The French government, under President Nicolas Sarkozy, made clear that Société Générale's failure was unacceptable. This was national pride. This was systemic stability. The capital raise succeeded, barely. Compare this to Barings Bank in 1995. Nick Leeson lost $1.3 billion trading Singapore futures. Barings was smaller than Société Générale, but the loss was proportionally similar. Barings collapsed. It was sold to ING for £1. A 233-year-old institution ended over one weekend. Why did Barings die while Société Générale survived? Size matters. Société Générale was too big to fail in the eyes of the French government. Barings was big enough to hurt, but small enough to sacrifice. But survival came with consequences. Société Générale's reputation was destroyed. How do you trust a bank that let one junior trader hide $73 billion? The French Banking Commission launched investigations. How did risk controls fail 75 times? Why were supervisors ignoring alarms? The investigation revealed systemic negligence, inadequate oversight, insufficient controls, cultural pressure for profits over risk management. The regulatory fallout was severe. Société Générale was forced to completely overhaul risk management, segregate trading from back-office knowledge, implement real-time position monitoring, require verification of all hedge positions. The changes cost hundreds of millions and took years. Every major bank in Europe studied what went wrong and implemented similar controls. At least, that's what they claimed. As for Kerviel, the criminal trial began in 2010. He was charged with forgery, breach of trust, and unauthorized computer use. His defense was simple. My supervisors knew. They benefited from my profits. When things went bad, they made me the scapegoat. He presented emails showing supervisors were aware of irregular positions. He argued the culture encouraged risk-taking and rule-bending as long as you made money. The court wasn't convinced. October 2010, Kerviel was convicted on all charges, sentenced to 5 years in prison, ordered to repay $4.9 billion to Société Générale. The restitution was symbolic. He'd never earned that much in 10 lifetimes. He served 5 months in 2014 before release. Société Générale wrote off any hope of collecting. But Kerviel's conviction didn't answer the real question. Was he a criminal mastermind? Or was he a symptom of a system designed to create Jérôme Kerviels? Let's talk about why this keeps happening. Because Jérôme Kerviel wasn't unique, he was inevitable. The banking system, particularly in investment banking, is structurally designed to encourage exactly this behavior. Start with compensation. A trader at a major bank can make bonuses 10 times their base salary. If you're good, you can earn millions. The formula is simple. A percentage of the profits you generate goes to you as a bonus. Make the bank $100 million, you might take home $5 million. This creates unlimited upside. But here's the other side. What's your downside? You lose your job. That's it. You can't lose more than your employment. This asymmetry is called moral hazard. Heads, you win millions. Tails, you lose a job you can replace. The incentive is obvious. Take massive risks. If they pay off, you're rich. If they don't, the bank absorbs the loss. At Société Générale specifically, the culture in the 2000s was aggressive growth. After 2000, European banks were competing with American investment banks for talent and market share. Growth targets were ambitious. Traders were pushed to generate bigger profits. Risk management was seen as an obstacle, not a safeguard. This wasn't unique to Société Générale. It was industry-wide. Now add technology. Banks in 2008 were running risk management systems designed in the 1990s. Markets had become vastly more complex. Trading volumes had exploded. Derivative instruments had proliferated. But the systems monitoring all this were legacy software. Slow to update, easy to game if you understood their logic. Kerviel understood their logic because he'd worked with them for 5 years in the back office. Then there's supervisory capture. In most banks, successful traders make far more money than the compliance officers monitoring them. A star trader might make $5 million. The compliance officer checking their trades makes $100,000. This creates a power imbalance. The trader is valuable to the institution. The compliance officer is a cost center. When conflicts arise, who do you think management sides with? The person making millions or the person costing money? The numbers prove this isn't isolated. In 2008 alone, rogue trading losses globally exceeded $100 billion. Société Générale lost $4.9 billion to Kerviel. UBS lost $2.3 billion to Kweku Adeboli in 2011. JP Morgan lost $6.2 billion to Bruno Ixel, the London whale, in 2012. Allied Irish Bank lost $691 million to John Rusnak in 2002. Sumitomo Corporation lost $2.6 billion to Yasuo Hamanaka in 1996. This pattern repeats across decades, across countries, across institutions. European banks were particularly vulnerable because they had weaker controls than American banks post-Sarbanes-Oxley. American regulations after Enron had forced more rigorous oversight. European regulators were lighter touch. National regulators supervised banks, but banks operated globally. A French trader could trade German futures through a British broker using American derivatives. Who's responsible for oversight? Everyone and no one. The uncomfortable truth is, banks didn't want stronger controls. Controls cost money. They slow down trading. They limit profit potential. And every bank believed their risk management was adequate until it wasn't. After Kerviel, every major bank claimed they'd fixed the problems. But 4 years later, J.P. Morgan's London whale proved nothing had fundamentally changed. The system was still broken, and 2008 was about to break it completely. January 2008 wasn't random timing. Kerviel's $73 billion unwind happened at the worst possible moment in modern financial history. The subprime mortgage crisis was already metastasizing into something much larger. Credit markets were freezing. Interbank lending was seizing up. Bear Stearns was weeks away from collapse. March 2008, 2 months after Kerviel's discovery, Bear Stearns fails. J.P. Morgan acquires it in a fire sale for $10 per share. The stock had been $170 a year earlier. September 2008, Lehman Brothers collapses. The entire global financial system nearly dies. The Federal Reserve and central banks worldwide inject trillions to prevent complete meltdown. The Great Recession destroys millions of jobs and trillions in wealth. Kerviel's timing was catastrophic. His $73 billion in long positions were betting European markets would rise. But markets were entering the worst decline since the Great Depression. If he'd been discovered in 2006 during the bull market, his positions might have been profitable when unwound. He might have walked away with a reprimand and the bank with a profit. Timing determined whether he was a rogue genius or a catastrophic failure. He got catastrophic failure. But here's the deeper question. Did Kerviel's unwind contribute to the 2008 crisis, or was he just a victim of it? Those 3 days in January when Société Générale dumped $73 billion in futures corresponded to one of the sharpest market declines of early 2008. The Euro Stoxx 50 dropped 6%. That selling pressure affected every investor holding European stocks, pension funds, retirement accounts, index funds, mutual funds. The ripple effects were enormous. Systemic risk works like this. When one institution is forced to sell massive positions quickly, they move markets. Other institutions holding similar positions see their values drop. If those institutions are leveraged, they might face margin calls requiring them to sell. Their selling pushes markets lower. More margin calls, more selling. The cascade feeds itself. Kerviel's $73 billion liquidation could have triggered exactly this kind of cascade in already fragile markets. But we have to be honest about causation. Kerviel didn't cause the subprime crisis. He didn't cause Lehman's failure. His losses were tiny compared to the trillions lost in mortgage-backed securities. Some argued he was actually a scapegoat. Société Générale had substantial subprime exposure. Maybe they used Kerviel as cover for broader losses. Blame the rogue trader instead of admitting systemic failures. The evidence doesn't support the scapegoat theory. Investigations confirmed his positions were real. The trades existed. The liquidation happened as described. The timeline checks out. But the scapegoat theory reveals something important about 2008. Everyone was looking for simple villains, greedy traders, reckless bankers, fraudulent individuals. The truth was more uncomfortable. The entire system was broken. Compensation incentives encouraged reckless risk. Regulations failed to keep pace with complexity. Leverage was excessive across the industry. Too big to fail institutions took massive risks knowing taxpayers would absorb losses. Kerviel was guilty of fraud. That's undeniable. But he was also a symptom. The disease was a financial system that privatized profits and socialized losses. Where individuals collected millions in bonuses during good years and walked away with job losses during bad years, while institutions collapsed and economies suffered. So was he a criminal or a product of criminal incentives? Jérôme Kerviel's defense was consistent from the moment he surrendered. My superiors knew what I was doing. They saw the profits. They asked no questions. When markets turned, they needed a scapegoat. And there's evidence supporting his claim. In 2007, when his unauthorized trades generated $1.4 billion in profit, he was offered a bonus. He refused it. Why? He later claimed he knew the trades were unauthorized and didn't want to profit personally. But Société Générale kept the $1.4 billion. They booked those profits. Management saw those numbers and never investigated how a junior Delta One trader was generating returns that exceptional. The 75 risk alarms between 2005 and 2008 support his version. Every time the automated systems flagged anomalies, supervisors dismissed them. Emails from those exchanges show supervisors accepted flimsy explanations. Some emails suggest supervisors knew his positions weren't properly hedged but didn't push back because he was profitable. In banking culture, profit erases a lot of questions, but the evidence against Kerviel is stronger. No smoking gun email shows explicit authorization. No supervisor testified they approved 73 billion positions. His fake trades using counterparty codes were clear fraud. The forward-dated fictitious trades that he canceled and rolled over weren't gray area risk-taking. They were fabrications designed to deceive. The court examined all evidence and concluded he acted alone, without authorization, committing deliberate fraud. His conviction was upheld on appeal in 2014. He served 5 months in prison, released in 2014. The $49 billion restitution was never collected and eventually written off. Today, Kerviel works in IT. He's written books about his experience. He's become a minor celebrity in France, speaking about banking culture and systemic problems. Some view him as a whistleblower exposing institutional hypocrisy. Others see him as a criminal who destroyed billions and refuses accountability. Société Générale recovered. By 2012, the stock had regained most losses. The bank still exists, still operates globally, still ranks among Europe's largest financial institutions. The emergency capital raise worked, the reforms were implemented, life moved on. Which raises the question, did anything actually change? In 2012, 4 years after Kerviel, JP Morgan's London whale, Bruno Ixel, lost $6.2 billion trading credit derivatives. Same pattern. Trader exceeds limits. Supervisors ignore warnings. Fictitious trades mask risk. Bank discovers losses too late. The London whale loss was actually larger than Kerviel's. Nothing had been learned. The system still incentivizes this behavior. Compensation structures remain asymmetric. Traders still collect millions in bonuses for short-term profits and walk away when risks explode. Technology is better now, but high-frequency trading has made markets more complex, not less. More algorithms, more derivatives, more leverage, more opportunities for things to go catastrophically wrong. Regulations increased after 2008. Basel III capital requirements, Dodd-Frank stress tests, European MiFID II controls. But regulations always lag innovation. Traders find new ways to game new rules. Here's what matters to you. Your retirement account holds mutual funds. Those funds hold bank stocks. Those banks have traders taking risks you'll never see until losses are announced. Diversification helps, but systemic risk is exactly that, systemic. When the system breaks, diversification across broken parts doesn't save you. Kerviel was guilty. The trial got that right. But he was guilty of doing what the system incentivized him to do, just without permission. The real crime was building a financial system where Jérôme Kerviels are inevitable.